In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, good afternoon once again, Market Rebels, and to all of our YouTubers out there. And today we have Scott Thorstensen back with us. Scott, thanks for joining us.
Thanks for having me, Bill. Good
of
to
course.
be here.
And of course, Stu is here every day. Everybody knows Stu.
Hey, everyone. Scott, good to have you.
Yeah, great to have you. Kind of a little roller coaster in the market today. Took a little gap down and what was it, somewhere around 10:30 or so, shortly after the opening, kind of been rallying back.
Bottomed out, and ever since then is kind of slowly and surely upticking through.
Yeah, that's what I remember. Kind of a slow, steady uptrend. We were talking about that in Q&A, and still continued to climb.
It's looking ugly in the morning.
It was looking really scary. I know. For today. Oh, and by the way, I forgot. I've got to give a big shout out to Sandy, all the way from China, for our first-time listener. So great having you here.
Yep, welcome, Sandy.
And today, we wanted to talk about a problem that we've encountered. We've all encountered it. We get it all the time, Stu, in Q&A, because people hear about rolling an option, and they say, "Oh, I've been trained. I got to roll the option." And there's a very big trap that people potentially step into. And we just wanted to point out what that trap is and what you really want to be focusing on, even though you might be technically rolling an option. Might not be the kind of roll that you want to do. So as always, let's kick it off with a little chalk talk. And for anybody who's new, this is a little kind of a little brain teaser question, whatever you want to call it. We'd like you to kind of jot down your answer, think about it for a moment, commit to an answer, and then at the end of this presentation, we'll go through the answer. So here's today's question. You buy a $100 call, let's say that you spend $6 on it. Stock rises, maybe it goes up to 110. Question is, which roll is a hedge against losses? You could either sell the 100-105 vertical spread, or you could buy the 100 calendar spread. What are the effects of those two things? Which would you choose and why?
So what are we really asking? Do we roll up or do we roll out?
Yep, you could look at it that way. The vertical spread is a roll up. It's just a fancier way, of faster, more efficient way. We'll talk about that later in the presentation. And the calendar would be a way of rolling out. That's exactly right. And that's, as we're going to find out, that's really where the little trap is that people step into.
Is that something I need to know? Won't my platform just tell me what it's doing?
We're going to find out that your platform is probably defaulting to the thing that you don't want to do.
That's why we're here.
Kind of jumping ahead to the answer there without even knowing it, but that's exactly what we're going to be talking about.
All right. Sorry.
So, presentation for today, the number one goal of the roll. Now, there's lots of different goals, but what we're talking about is when you hear people talking about this term roll, you got to roll your option. They're talking about a defensive move to reduce the amount of risk in the trade. And that's typically, without other qualifications, what people refer to when they hear about rolling an option. But as Stu just said, you're going to find out there's a potential trap you could step into on most platforms. So let's first cover, for some definitions here, guys, the various types of rolls. Two terms you need to, or actually four you need to be aware of. Two refer to time and two to your strikes. When we use the terms in and out, we are referring to time. And if we are using the terms up and down, we are referring to strikes or to the various prices. So looking at it from a option chain, let's say we get our expirations across the top, we get our strikes over here at the far left. Here's our option prices. If you roll out, you might be going from, let's say, February to March, but you're staying in a given row. So maybe you own this first row right here, the $90 call for February. If you sell the Feb 90 and buy the March 90, you are rolling out in time. The opposite of that would be rolling in. So if you own February 90 and want to roll to January 90, we're keeping the strikes the same. That's rolling in. And there are some very good strategic reasons why we might want to roll in. Over on the left-hand side, if we roll up, we're going to be going to higher strikes. So now we might be staying within January, let's say selling the 100 and buying the 105. That would be a roll up. But we could also roll down. And that could be with calls or puts. I might have the 100 call and roll down to the 95, or have the 100 put and roll down to the 95, but I'm staying within a given expiration.
Bill, here's a little option trivia. This is, I don't know, I have no idea if this is true. This is what I always heard through the years. So originally, way back in the day, when they started presenting options on the screens, on the monitors, the matrix was always presented this way, with the strikes on the left going up and down and the time going out. Sometimes today's on different platforms, it's different, but this is how it was originally always disseminated. And the spreads that we commonly refer to these days as vertical or calendar can also be horizontal or time spread. So they're the same. There are just three different names for the same thing. The calendar spreads were given given the name calendar because it was presented this way to move through the calendar. They were just
spreading off different months. Yep. And
it was a true calendar, and that true calendar is always going to be same strike, different
months.
Yep. And the up and down was just moving up, and it was just moving through strikes, and that became what's known as today the vertical spread. And that's it.
And we can also go diagonally too. That's where the diagonal spread came from.
Right, you were moving through both of them. Yep. And that became, if you just draw a line through the 95 from January to February in different strikes, with it would just be a diagonal spread, and that's how it will spread.
And those are all different types of rolls, and there's actually two different diagonals we could go off. And so we've talked about this before, Stu, in Q&A, where if you are doing a diagonal, you're really mathematically doing the combination of a horizontal or a calendar and a vertical. So those are important concepts to know if you're going to be involved, first of all, in options, but especially for rolling, because those play super important parts for making the best decisions. So let's dive in a little bit further and find out where this trap can lie. And as always, before we do that, for anybody who's new, please check us out at marketrebellion.com/get started. Lots of great materials on there, videos, lots of great articles to read that can help you to get started to make better decisions. So let's start with rolling. Whenever you hear the term rolling, in the absence of any other qualifications, your friend, your coach, whatever says we need to roll this option, they are most likely talking about rolling up for a call or rolling down for puts. For this presentation, I'm just going to stick with calls. So we would be talking about rolling up. So what is that, and why do we do it?
Further out of the money. Right.
Exactly. Yep. We want to go, whether it's a call or a put, you're moving further out of the money. So we would roll the calls up and the puts down. So let's say that you buy this $100 call for $6. Now you will roll up when the option has gained sufficient intrinsic value. I know that's up for debate. What's sufficient? And this is where a lot of experience and coaching can help. Sometimes if you're dealing with longer dated options and high deltas, we might roll for a $4 credit out of the 5 or 80% of the difference in strikes. if you're doing shorter term options, it might make perfect sense to roll for 75 cents or for $1. So I'm going to leave that a little bit vague right now.
Yeah,
but
just examples, even out of the monies. Look, if you start with a 30 and you go to a 50, maybe you roll back to a 30 or a 25.
Absolutely.
This is just an example.
Yep. So let's say that you sell this $100 call, the one that you bought, and you buy the 105 call. And let's just say that you get a net credit of 4. This is the real reason for doing the roll up. We want to get cash in our pocket. So now, if you think about it, we effectively own the 105 call for 2. Why? We spent 6, right? So think about that. You spent $6 and now you get $4 back. So on a net basis, you're only out 2. You still own a call. Granted, it's the 105, not the 100, but you own it for an effective cost of 2.
And we materially reduced our other Greeks as well.
Yes, we have.
We reduced our delta, our gamma, our theta, our vega probably, and our rho as well.
Absolutely true.
You got to remember what you're trying to do here, guys and gals. You're trying to mitigate risk. That's the goal here. You're trying to take something off the table.
Right. So again, when we're talking about rolling up for calls or rolling down for puts, the goal is to reduce the amount of money in the trade. This is probably the essence of this entire presentation. And we find that a lot of people miss this. And we'll see what that trap is in a moment. So if you always remember that this is your goal, is to reduce the amount of money. We'd like to get these credits, but still keep unlimited, in this case, upside. So here's what we've done. Remember, we started buying this call for 6. We rolled for a credit of 4. So here's our $100 call. There's our bend. We always get a bend at a strike at -6. Now, when we did the roll that we just saw on the previous screen for $4, we moved from the red to the blue. And the main reason for doing this is that right there. We want to raise this floor. Now, if everything comes off the rails, we can only lose $2 instead of 6. We still have unlimited upside. All right, you can see that blue line still goes on forever to the upside. Now, there is a trade-off because this blue line sits a little further to the right of the red.
All right, we do have a break even, but it's a trade-off.
We've increased the break even a little bit. Yeah. So mathematically, if we got a $4 credit here, we know that we've effectively mathematically paid $1 for the put. That's a separate story, but those are some of the things that we show students and traders of how to make better decisions. But now let's say that we get another roll for another $4. We've moved from the blue.
Hold on, time out, Bill. What do you mean? You sell them for 4, but you do what?
If you get a $4 credit here from rolling up, you have mathematically paid $1 for the put.
Should we do a coach's corner on that one day?
I think did we do one or no? If not, we'll have to do it. I think that would be a good one to show that connection.
Good one. That is the basis of everything that we talk about.
That's the basis of the rolls.
And if anybody out there who doesn't really, is a little fuzzy on what we're talking about, this little banter that I'm creating between Bill and myself, Scotty, stay tuned.
This is really where a lot of traders make mistakes. They might roll from the 100 to the 105 for 50 cents, and they go, hey, money's money. At least I got 50 cents in my pocket. Yeah. But they don't realize they just shoved their break-even point out by $4.50. Yeah, nice they pretty much guaranteed a loss, albeit a smaller one.
Yeah, or
not a good way to trade. No. So if we were able to get this roll off again, let's say for another $4, we've gone from the blue to the green. Now something special happens here because over on the left, this 0, this little horizontal line, means that we are just breaking even. And look at this. The entire green curve sits above 0 by $2. All right, so how did that happen? We paid 6. We brought in 4 from the first roll. We brought in 4 from the second. That's 8. If you spend 6 and collect 8, that's now a net $2 profit in your pocket. So we spent 6. We've got a guaranteed 33%. But what do we still have up here on the upside, guys?
Unlimited upside.
We still have unlimited upside. And in fact, we might not have even let go of our deltas. I might have had 85 delta here on the red and rolled to another 85 delta on the blue and rolled to another 85 delta on the green.
Even though I'm selling options and
collecting cash.
Right. Collecting cash and I keep my deltas. Mr. Mr. and Mrs. Gamma come into play. I think we talked about that.
Oh, yeah. We did that last week. Now, there's some other things that we could do here. Scotty, I know that you've got actually a number of techniques that you like to teach your students. What's something, let's say that somebody had 10 contracts here and is rolling. What's something else that you could do?
One approach is to roll half and trim half. So
love it.
Roll a portion. If you had 10 contracts, sell 5, roll the other 5.
And what's the purpose there? Now you get an even bigger pile of cash.
Yeah.
And yet you still have the unlimited upside. So
the money.
The options change in value fast, right? They're leveraged securities. So when you have a profit, you've got to keep them. And rolling these profit-taking approaches are critical. And you see a profit in your hand and it can disappear. So you've got to aggressively roll. You've got to trim. It's very important. Yeah.
Yep, and that's why we find...
Man. Nicely put. Excellent.
That's why we find so many new students will come in and they'll say, well, I bought this option for $6 and I was terrified of losing. So I sold it for $6.50. And now let me go buy something else. That's what we call picking up nickels in front of bulldozers. That's only going to work for so long. And the thing is, the trick is to succeed with the options is that you stay in it, especially if you've got the momentum going in your favor and it's running. But how do you manage that risk? We don't want to watch this $6 option go to a $25 option and do nothing about it.
No, you make these adjustments along the path.
It's always about adjusting over time. We've talked about that before, Stu, where we say that the real trick to the options is not so much about what you buy. Anybody can pick a good stock or just happen to get lucky and buy the one that's running. But how do you manage it over time?
Yeah,
the reason that they don't do as well as the professional traders is that very reason. You've got to learn how to manage it over time. So what we talked about here is this roll up. And as a more efficient way, kind of alluded to this a little bit ago, or Stu did, I guess, on the opening slide, we roll up with a vertical spread. So watch what happens here. If we sell the $100 call, that would be a closing transaction. We buy the 105 call, that would be to open. What you've done here, if we do it as a simultaneous trade, we could sell the 100-105 vertical spread.
Yep.
And that is a more efficient way. Why? Because the net credit is stable.
You got to isolate what risks you're trying to get and
absolutely
and go away from. You're not looking to participate in market movement, market execution risk. You're looking to simply exchange one without the movement of the market affecting you.
Absolutely. So let's say if this is our 100 call that we're long, I could sell the 100 call by itself as a single trade, wait for that to execute, and then buy the 105. And these two would cancel. But we can also look at this trade on the right. What is that? That's also a vertical spread. I could put that in as a single trade instead of two separate trades, and I can accomplish exactly the same thing. So the question is, well, why do we want to use a vertical spread to roll it? Why not just close out the 100, turn around and buy the 105? Good question. But professional traders are very aware of what's called execution risk. So watch what happens. Let's say that we've got we want to sell the 100 call and buy the 105 as two separate trades. What can happen? Well, let's say we've got our eye on this $4 credit. That's the current market value. So we say, oh, this is good. I can get $4 of my $5 roll here. And I start typing up the order. And what happens? Murphy's Law. As soon as I start putting in the order, the price of the stock falls on the option I'm trying to sell. Bummer. I get a little bit less than what I thought. I wait for that trade to execute, and what happens in the meantime? Stock starts to rise. So then I'm going in to buy the 105 call in a rising market, and I get hit again. So even though I had my eye on this $4 credit, I might end up getting something like $3.70.
Or 3.
or 3
or right.
2 and some people say, well, couldn't you get more? Of course, but that's not a risk. It's called execution risk, not execution lottery. This is why we teach people the various types of rolls, and depending on what you're trying to do, sometimes you'll do a vertical, sometimes it'll be a calendar, might even be a diagonal. And then if it's a diagonal, which direction do we go on the diagonal? Remember, there's 2 diagonals on that grid. So this is why you have to know this stuff. Okay, so that's all.
Build your trade, right? Read your
Absolutely.
trade. before you send it, build it, read it, make sure that it
Yep.
you say you want to do, and that infers that you know what you want to do. And then once you get all that done and you're 100% comfortable with what you put in is what you want to do, then send it.
Absolutely.
Then send it.
So the thing is that if the market is trending up and we do this as a vertical spread, that $4 credit will stay about stable. Yeah, you're going to pay more for your long, but you're also going to receive more for the short. And that tends to balance out. Same is true on the downside. You're going to receive less for the one you're selling, but you're also going to pay less for the one you're buying. And that $4 credit tends to stay stable. But as soon as you break them apart, all bets are off and it's you against Murphy's Law.
Yeah.
So that's why we always teach people to understand the various types of rolls. They make a very big difference in your success.
The net delta on the spread is ridiculously lower than the individual delta.
And that's another good point too. That's right. That's part of what's keeping them stable, right? Yep. So now, with all this being said, we're going, okay, I understand now what a roll-up is. I understand that I should be doing vertical spreads. But where's the risk? There's a risk in all of this. When people hear that you should be rolling your options, this is what we started talking about at the very beginning. So what is this risk? Well, here's the risk that people run into without knowing it. And before we do it, as always, little plug here, please remember marketrebellion.com/get started. I cannot emphasize this enough. There's so much bad information out there. And I just sent Stu a text link from YouTube. It was so incredibly bad, but it's out there. So just make sure that you're finding good sources for your information. We've got a lot of free materials there to help you get started.
We guarantee that we will give you 100, 50 trades that will make 100%.
Yeah, 100% or more. Guaranteed.
Guaranteed.
Oh, brother.
Really run fast.
In the opposite direction. So here's the potential trap. All right. So again, think about the story that we're telling here. We want to roll our calls up and our puts down. Everybody says, got it. Understand. We want to use a vertical spread for that. Got it. Understand. So where's the problem with this? Well, again, people hear, well, my coach told me I got to roll my options, or my friend said I got to roll my options. So I go to my platform, and when I click on roll, it defaults to a roll out.
And it might not even say roll out. It might
probably won't. It's just going to say roll.
Yeah.
And is that wrong? No, it's a type of roll. You got to have some kind of a default. If it defaulted to roll up, we could say, well, we need a roll out. It's got to pick one. So it's usually assuming that people get to the end of the expiration and they want to roll out in time. But that's not always true. Some very good arguments can be made that why you really want to focus on the roll up. So for example, let's say that you buy the July 100 call for 6. This is the one we've been looking at. But now the stock is at 110. All right, so we got this nice little rally, and you roll out by buying the July-August 100 calendar. That's the way it's going to look on your broker's platform. Mm-hmm. Notice we have the same strike. What was a calendar? We're moving horizontally. We are selling July and we're buying August. Going to just keep the strikes the same. Now, because we're buying more time, keeping the strike the same, it will absolutely positively be a net debit. But now the question is, guys, what did this accomplish? Did we really roll our option like we thought we were supposed to and getting this nice cash back and trying to protect the downside? Well, here's what it did. The blue line is the current curve, and I think I had 15 days until expiration on this one. And we go out to the red curve, which is 90 days. But it doesn't matter. It's just that you've got a short term versus a longer term. Now, notice what happened. If we compare the blue to the red, over on the far left, we could potentially lose more by rolling out. And that's because we had to spend money on the trade. Over on this side, what happened? If the stock runs, we're going to make less because the red sits below the blue. And remember that the stock was down here around 110. What do you notice? We have lower deltas. The red line is flatter than it is on the blue.
Just think about what you're going from and what you're going to. If you
You're
roll out,
losing.
you're
Yeah,
spending
you're losing.
you're spending more dollars. You just have more dollars on the table, right? You're selling a $3 option, you're buying a $5 option. You got $5 now that's sitting on the table. Your whole goal is to reduce the dollars, not increase the dollars.
Right. But now take a look. We do have this little green wedge where the red line does sit above the blue. What's happening here? Well, what's happening here is because we've piled on some more extrinsic value. The option's value is more, assuming we still have time until expiration. But what's going to happen over time is that that's going to sink below the blue. So the thing to notice here is that when you rolled out, we bought time. And what in exchange, we received lower deltas, we have a larger potential loss, and a lower potential reward.
A little bit lower. It's not a whole lot.
Yeah, not a lot, but it's still, the fact is this is not the direction that you wanted to go. But you could make a small argument, okay, yeah, you've got lower deltas here, but remember, we're expecting the stock price to rise,
and
to rally.
Here's another thing. If these are out of the money options, you actually might increase deltas if you did that.
We're gonna get to that.
And you may not want to do that, right? You just have to remember what it is you're trying to do.
Yep. So take a look what's going to happen. So you might look like you have a little benefit through here because the red line sits above the blue, but watch what happens over time. If it takes too long for the stock to rally, that red line is moving to this one. And now we can clearly see that had you stayed where you were, you'd be better off on all fronts. It's just, it's piling on risk for absolutely virtually no reward. Maybe a small argument about Vega, but I mean, who rolls out for a few weeks for Vega or a couple of months? It's not even, you would never do it for a Vega roll. No. Yeah. Now, here's another question, guys. Is this always true? Do we always want to tell people that you never want to roll out early? What's our favorite answer?
What do you tell people, Scotty? What do you?
Well, it depends on their expected holding period and the targets they have for the stock. The short-term trade, you definitely want to roll aggressively. Don't want to roll out in time. You don't want to talk yourself into staying in a trade too long. Right? If you expect to be in the trade for a few days and you roll out in time, psychologically, you may entice yourself to stay in a trade longer than what you should.
It's actually a very good point. Yep, you give yourself a false sense of confidence that you want to stay in it. So our favorite term for any options question, all of our traders in Q&A know this, it depends. Right? People ask us questions now and they jump the gun, they start answering for us. They go, it depends. We go, yeah, we got it. Because you know why? It always depends. Options have a lot of different moving parts and it depends on what your assumptions are. So here's one case where it might make sense to roll out early with out of the money options. What Stu was just talking about. If you have whether you purchased an out of the money option or maybe an in the money that fell out of the money, they have low deltas. And if you say, you know what, I'm still bullish on this stock, well, what could you do? You might be able to roll out and increase your deltas. So now let's go and compare two options again. We've got a $100 call with 15 days to expiration, but now the stock has fallen to 90. Doesn't matter if this was deep in the money at one time, it's now at 90. And if we roll out to the 100 call with 90 days to expiration, what happens? Notice we're going from 100 strike to 100, but we're going out in time. It's a calendar spread. It's what we just saw. But we're going to see something very different here, right? So what do our risk graphs look like now? Well, again, looks very similar to what we just saw, but remember that the stock is down here at 90. So if we stay on the blue, look at how flat those deltas are. I mean, who wants that? If you really and truly are bullish, get on the red line. Get those deltas up here. So yes, you do buy time by rolling out, but you also bought higher deltas. I mean, who wants to do it for Vega? All right, so yes, we still have this little green sliver in here, but notice that we are moving into the green, whereas before we were moving away from the green. We wanted the stock to go here. The benefit is behind us. And that's why if you are in a situation where you should be rolling up and you're rolling out because it's an in-the-money option, you really shot yourself in the foot. And yet that's how most platforms will default. I don't know. Scotty, do you know of any studio? I don't, all the platforms I've ever seen always default to roll out. Kind of a curiosity.
They all roll out.
Yeah, I think so too. I think that's always the default.
Yeah, I've yet to see one that rolls up.
And usually to the next strike and to the next expiration. So if you have a weekly option that trades in dollar increments, it's going to roll you out 1 week actually at the same strike. Or if you want to go up and out, it'll just go up by $1. Probably the things you don't want to do.
Yeah, Scotty, do you ever get people that tell you, yeah, I rolled this option and they went from like a 35 to a 35.5 strike?
Oh yeah. Inadvertently, they
got a 20-cent credit.
Less experienced, students with the platform. You got to remember that you're the captain of the ship. You're the quarterback. The platform defaults to rolling out in time. You've got to change the strike. You've got to tell the system to do what you want to do.
Right.
So yeah, there has been those scenarios, Stu, where I've seen students end up taking more risk and
inadvertently. That's exactly what we're here to talk about. People do it because they say, well, I don't understand these roles. Let me break the trades apart. Let me sell this one, wait for an execution, and then buy this one. Well, now you're faced with massive execution risk. So you've got to use these rolls. You've got to use the roll up or the vertical spreads, calendar spreads, diagonal spreads for your rolls, because otherwise you're subjecting yourself to massive execution risk. But you have to understand what the roll is doing. And that's the big trap that we find that people just don't understand.
Super important. Just follow the pricing, follow the money. Yep. You buy an option for $3 and it goes to $6. Well, now you got $3. What are you going to do with it? Well, if I dump it, I'll keep my $3. I'll get my $3 out of it. I'll keep my $3. Now, what are you going to do with that $3 that you just made? Well, maybe you buy a 1.5 or a $2 option. It's going to be really tough to lose once you do that. But the opposite will occur if you're just rolling for a half a strike or a half a point or a $1 or a $2 strike. I mean, it's just not worth it. And like Bill said before, the synthetic version of that is if you're rolling for $1 on a $5 spread, you just bought the put for $4. So you got to
$4, yeah.
Right? If
it's almost a synthetic sale. You've almost conceded and said, okay, look, I'm not going to ever make a profit, but I'm at least getting a little bit of cash back. But the new traders all think that they did something great by getting some cash back. They don't realize what the trade-off was. Yeah. So again, for a good visual, now remember the first example where we saw these graphs, or at least they look similar, that we were up here. The stock was up at 110. And to get to this benefit area, the stock had to fall. Well, our expectation is that it's going to rise. But see down here, the expectation is it's going to rise. We're moving into the green. And yes, these are very subtle points, but these are the things that people make the mistakes with.
And we haven't even mentioned implied volatility levels.
That's a whole separate conversation, but you're exactly right. I mean, that would be another thing to see if we're trading in the trough or doing some of these other mistakes that people
rolling
make.
Into an earnings cycle, which we may not want to.
Oh yeah. That happens a lot too. People roll out and they go right into an earnings cycle.
Yeah. Which is okay if you want to roll into an earnings cycle, but if you don't want to roll into an earnings cycle, then you got a problem.
Again, know your risk. All right. So I hope that helps everybody to make sense of some of these subtleties. These are the things that we like to teach here at Market Rebellion to make sure that people are making the most of their money and their decisions. So let's go back to our question here. We bought the 100 call for 6. Stock rises to 110. Which role is a hedge against losses? What's our answer here?
Guys,
sell the vertical. Sell the vertical.
Sell the vertical.
Mm-hmm.
That's the one I chose to.
Yeah, and
now, buying the calendar in some cases maybe for an out of the money, but this isn't an out of the money option. See, so again, you have to realize it always depends.
Always remember what you're trying to do and what you're going to walk away with after you get done what it is that you're doing.
Yeah.
Right.
Very, very well said. So I hope that helps everybody to, even if you found it confusing, I think that's still helpful information because it shows you probably don't know what you thought you know. Yeah. There's a lot of moving parts with the options, and one little change can make very big differences.
Yeah.
So any closing thoughts, considerations, pearls of wisdom? Scotty, let's start with you.
One thing that comes to mind, Bill, when you're rolling, there is a cost of rolling, and sometimes with the less liquid. I know most of you are trading highly liquid products. trade the Apple, the Qs, a large cap ETF, you have really tight bid-ask spreads, but there is a cost of rolling, and it may be more beneficial to trim your position rather than rolling. So those are some things to consider.
I do that all the time. It's one of my favorite trades. You hear John and Pete talk about that sell half and roll half type of things, or sell 30% and roll the remaining 70. There's all kinds of ways to mix and match it. But I love the idea of being able to sell a portion as a way to get yourself into a guaranteed profit faster.
Yeah. Don't ever think that you have to, do, first of all, don't ever think that you have to do something, right? Oh, you always have a choice.
Good point.
Right. The market doesn't dictate what you can do. The market's only there for your enjoyment.
And doing nothing, isn't that what Greg teaches in the pit? Doing nothing is a choice.
It is a choice. Absolutely. It took me a long time
to
figure that out, but doing nothing is a choice. And this combination of trimming and rolling is such a fantastic combination. Don't feel that oh, I'm going to roll and I'm done. Or don't feel, well, I'll just sell half and keep half. No. Roll, sell half. Sell a portion of it, like Bill said, 30%, 60%, 70%. Sell something. Sell something and roll the balance, and let the gamma replace your delta that you're giving away on the sales.
Yep. So I think for my contribution here to this part of the conversation, I'm going to steal a quote from our good friend Stephen Levick, who we had on actually several months ago now. Yeah. All of these points that Stu and Scotty made are perfectly valid and wonderful strategies, assuming you, what did he tell us?
Know your risk.
Know your risk. And if you know that, the decisions are easy.
Yeah.
That's what it all comes. That's why people find this stuff confusing. So if you're in that boat and find that this stuff seems a little confusing and that it's not just buying a call because you think the stock is going up, please give us a shot. marketrebellion.com/get started. And we hope you've picked up a few tidbits today. That's what it's all about. And we will see you next Thursday, 4 p.m. And Scotty, thanks for joining us today.
Yeah.
Thanks for having me, Bill. Thanks
everyone. We'll see you next week.
All right. See you, everyone.